George, relatively soon, does that mean an announcement in September and a beginning to maybe some action in October?
That's how we're viewing it. I mean, obviously, there's a lot that's taking place in September, which could, come into influencing the Fed's decision on actually launching it in September, and then implementing it in October 1st for a start in the Q4. But I think this is lined up nicely. The Fed has almost done the opposite of what they did during 2013 taper tantrum. They put out all the explanations ahead of time before pulling the trigger, and so with the intentions and the hope that when they actually do it, the markets are going to be well prepared for it.
George, you talk about positioning, you talk about this cycle being an anomaly, therefore it should be analysed differently. So let's cut to the chase. What does that mean for trading? What should we buy as a result of that?
Well, it's really a function of buy and sell, right? I mean, there's going to be a lot of relative value opportunities, I think, throughout this period in Treasury space, but even if we look beyond that, my colleagues on the mortgage side are underweight the MBS spaces because there's going to be not just the portion of the Fed's Treasury holdings that are coming off, but also the mortgage side. And I think we've been living in a world where investors have not really had to hedge for two-way risk of rates actually going up and down, and I think that's going to cause for some volatility over the course of time. The first 3 months might feel like a snoozer because they're going to go about it so very, very glacially slow. But we do think that cumulatively speaking, as we look towards next year, they're going to be putting a lot of paper back into the system, and the private sector is going to have to actually take that and discount it at a much higher yield, we think, and wider spreads.
George, the 530s in particular has been steepening, the long end getting steeper. If you actually look at the 530 spread, you see it's still pretty low. I mean, in comparison, pretty narrow.
Yes.
But we're at what, 107 basis points or so now. Where does that go, and how do you benefit trading-wise from that?
So what's interesting, like typically in a normal Fed cycle, and this is what we've been going against because we think this is a very unique, unconventional period that we're coming from. Therefore, it's going to be an unconventional tightening period as well. The curves typically flatten down towards zero, almost completely going away. No difference between short-term rates and long-term rates. I think the number of things are happening here. Both the market is preparing for the Fed announcement, but also the Treasury has to finance all this paper. And how exactly does the actual U.S. government go about terming out its debt? Rates are low. Secretary of Treasury Mnuchin has mentioned that rates are low. We should take advantage of that. There's been ideas of floating around of a 50-year security. Most of the street, including ourselves, like a 20-year security. But nonetheless, there's going to be more bonds in the system and potentially of longer duration nature. And I think that's what keeps the curve steep here.